Picture this for a moment. It's Sunday morning, February 15th, 2026, and something feels off, unusually quiet. No urgent alerts flashing across financial terminals. No frantic movement from Asian trading desks. No overnight price chaos rolling in before the US wakes up. Just silence. And that silence isn't random. It has a very specific cause. The Shanghai Gold Exchange, the largest physical precious metals exchange in the world, shut down yesterday for the Lunar New Year holiday, and it will remain closed until February 23rd, which means, for the next 9 days, the most important physical buyer in the global gold and silver market is completely offline. No price discovery from Shanghai. No massive Asian demand absorbing supply. No steady pull of physical metal moving east. Just quiet. And that quiet creates something extremely dangerous in financial markets. An information vacuum. A dead zone. A period where price can be pushed around without resistance. So grab your coffee, sit down with me for a few minutes, and listen carefully. Because when the East goes to sleep, the West tends to get aggressive. History shows it over and over again. And what we're stepping into right now is what I call a free fire zone. 9 days where paper prices can be redrawn almost at will while physical metal continues disappearing behind the scenes. Before we go further, I want to know where you're watching this from. Drop your city or country in the comments. Because the more people paying attention right now, the harder it becomes for the game to stay hidden. Now let's walk into the engine room and see how this machine actually works when nobody's watching. For the next 9 days, the metals market is effectively flying without its main pilot. And understand this clearly, the Shanghai Gold Exchange isn't just another regional marketplace. It's the largest physical delivery hub on the planet. When Shanghai is open, there's an enormous vacuum pulling gold and silver out of Western vaults into Eastern hands. That steady demand creates a price floor, a reality check. It tells the market, push the price too low and we'll buy everything available. But right now, that vacuum cleaner is switched off. Buyers are home celebrating. Banks are closed. Vault operations are paused. And when that demand disappears temporarily, markets enter what professionals call a liquidity vacuum. Think of it like a football match where the referee walks off the field and half the opposing team goes home. Suddenly, the remaining players control the entire game. And historically, the big trading desks in London and New York don't exactly play fair when they're left alone. Without Asian buying pressure, trading volume drops. And in low-volume markets, prices can be moved with surprisingly small amounts of money. This is where something called phantom selling shows up. You might see silver or gold suddenly drop 2 or 3% in minutes. Charts flash red. Panic spreads online. But if you dig into the data, almost no physical metal is actually changing hands. It's paper contracts being traded back and forth, often by automated algorithms, creating the illusion of selling pressure. So the obvious question becomes, why would anyone want to push prices down right now? To answer that, we have to look at inventory, the actual metal backing these contracts. And this is where the story gets uncomfortable. Imagine a major international airport. We'll call it COMEX Airport. There's a flight scheduled for delivery in March. Thousands of passengers hold tickets expecting seats. In market terms, those passengers are contract holders expecting delivery of silver. Right now, open interest shows claims on roughly 327 million ounces of silver. That's how much metal people believe they have rights to receive. Now let's walk onto the runway and look at the airplane itself. How many seats are actually available? According to the most recent vault reports, the amount of silver officially registered and ready for delivery sits around 98 million ounces. Do the math. 327 million ounces claimed. Only 98 million available. More than 3 claims for every ounce of deliverable metal. In any normal industry, selling 3 tickets for 1 seat would be called fraud. In commodities markets, they call it fractional reserve trading. The system assumes most ticket holders will never show up. Most traders settle for cash instead of demanding metal. But what happens if too many people decide they want delivery at the same time? That's the panic scenario exchanges and banks desperately try to avoid. And one way to prevent that panic? Push prices down hard enough that nervous investors sell their contracts before delivery arrives. If the chart looks scary, people exit voluntarily. Problem solved. Metal never needs to be delivered. But the situation gets even trickier when you hear analysts claim there's actually plenty of silver in vaults. They'll point to total inventory numbers that look much higher, sometimes over 400 million ounces. But here's the accounting trick. There are two categories, registered and eligible. Registered silver is metal that's actually for sale and available to fulfill contracts. Eligible silver, on the other hand, simply sits in vault storage but belongs to private owners. It's being stored for safekeeping, not for delivery. Think of a dealership parking lot with 10 cars. 9 belong to customers temporarily parked there. Only 1 actually belongs to the dealer and is available for purchase. From the street, it looks like full inventory. In reality, almost nothing is for sale. That's the difference between eligible and registered metal. And the reason we know supply is tight is because metal keeps leaving the vaults. Day after day, silver flows out to industrial users, solar manufacturers, electronics producers, electric vehicle companies. Inventory has fallen roughly 70% since 2020. That isn't normal fluctuation. That's a steady drain. And another signal confirms this pressure: lease rates. In healthy markets, borrowing silver is cheap because supply is abundant. Rates might sit around 0.3%. But recently, lease rates have jumped above 6% and even touched 8% earlier this year. Nobody pays that kind of premium unless supply is tight. It means banks don't want to lend metal because they're worried about getting it back. And this is where the fracture becomes visible. Lease rates scream shortage while paper prices on trading screens might show selling pressure. Two completely different realities. And over the next 9 days, while Shanghai remains closed, we're going to watch a battle between illusion and physical demand. The illusion will show up as falling prices on your screen. The reality will continue in vault withdrawals, tight lease markets, and massive contract overbooking. And that disconnect is exactly where markets become unpredictable. But you might be wondering, if supplies are tight, shouldn't prices explode higher immediately? Logically, yes. But markets don't move purely on logic. They move on psychology. And to understand what might happen next, we need to look at a moment not too far in the past, when the rulebook itself was rewritten mid-game. To understand what could unfold after this quiet week, we need to rewind to a moment when the market looked unstoppable and then suddenly collapsed. Back in 2011, silver was on fire. Prices were charging toward the psychological barrier of $50 an ounce. Momentum traders were piling in. Retail investors were excited. And large banks, the ones sitting on massive short positions, were suddenly trapped on the wrong side of the trade. They were facing serious losses. So what happened next? Did the market simply discover a fair price? Not exactly. Instead, the rules of the game were changed in real time. The exchange that oversees futures trading stepped in and repeatedly raised margin requirements, the amount of cash traders needed to hold their positions. And they didn't do it once. They did it 5 separate times in less than 2 weeks. Imagine playing poker, winning hand after hand, and suddenly the casino manager walks over and says, "From now on, everyone needs 50% more money on the table just to stay in the game." Most players can't do that instantly, so they're forced to sell. That's exactly what happened. Leveraged traders had to liquidate their silver positions to meet the new requirements. Selling triggered more selling. Panic spread, and within days, silver collapsed from nearly $50 to around $26. The banks escaped. The rally died. But here's the difference between then and now, and this difference is critical. Back in 2011, vaults still held plenty of metal. The crisis was financial, not physical. Today, inventory levels are dramatically lower relative to demand. You can manipulate leverage. You can change margin rules. But you cannot manufacture physical metal overnight. You cannot print silver bars. And that brings us to the real shift that has taken place over the past several years: the quiet transfer of metal from west to east. While Western markets focused on derivatives and financial engineering, Eastern nations focused on ownership. Gold and silver have steadily flowed out of London and New York vaults, melted down, refined into smaller bars preferred in Asia, and shipped to vaults in cities like Shanghai, Mumbai, and Singapore. This isn't speculation. It's visible in shipping flows, vault reports, and refinery activity. Countries within the BRICS group have openly discussed reducing reliance on the US dollar in trade settlements and increasing reserves backed by tangible assets. Physical metal matters in that equation. and Shanghai has increasingly become the place where price discovery reflects actual buying and selling of metal rather than just paper contracts. You can see this difference in price premiums. For months, silver prices in Shanghai have often traded noticeably higher than prices quoted in London. Why? Because contracts there typically result in delivery. Buyers expect metal, not just cash settlement. And that difference matters. Which brings us back to the situation unfolding right now. Shanghai is closed. Demand is temporarily paused. But when markets reopen, there will be days of accumulated buying interest waiting to return. And Western trading desks know this. They understand that once physical buying resumes, upward pressure could return quickly. So their only real option during this quiet window is to try pushing prices lower before Asian demand reappears. Trigger stop losses. Shake out weak holders. Cover short positions at lower prices. Classic strategy. But here's the piece many traders overlook. Financial markets might sleep during holidays. Factories don't. The industrial machine keeps running. Silver isn't just an investment asset. It's critical for electronics, solar panels, defense systems, and electric vehicles. Production lines cannot simply stop because prices are volatile. Supply managers don't speculate. They secure materials. And lately, many of them have been aggressively locking in supply. We've even seen situations where investment funds designed to track silver prices experienced overwhelming demand, pushing share prices above the value of underlying metal. In some cases, authorities stepped in to halt trading because pricing mechanisms were breaking down. At the wholesale level, dealers are reporting tightening supply of standard bullion products. Coins and bars that were once easily available now disappear quickly once restocked. That's not a sign of abundant supply. That's a sign of stress in fabrication and distribution. And remember those elevated lease rates? Industrial buyers often pay whatever premium is necessary to keep production moving. Shutting down a factory costs far more than paying extra for raw materials. This is what economists call inelastic demand. When supply tightens enough, price becomes secondary to availability. And all of this means something important for the coming days. You might see falling prices on your screen while physical supply remains difficult to secure. Paper markets may show weakness while actual demand remains strong. In other words, illusion and reality may continue moving in opposite directions, at least temporarily. And once Shanghai reopens and normal trading resumes, those two worlds may collide again. So enjoy this quiet while it lasts. Because the calm periods in markets often come right before volatility returns. Over the next several days, if prices fall sharply, ask yourself a simple question. Can physical metal actually be purchased at that lower price? Often, the answer is no. Premiums rise even when spot prices fall. And that tells you something important about underlying demand. At the end of the day, market participants face a choice. Sell positions in fear and take cash. Or hold through volatility and wait to see how physical demand reshapes price discovery once the largest buyers return. This isn't financial advice. It's simply a reminder to look beyond flashing numbers on a screen. The pilot may be temporarily absent, fuel levels may be uncertain, and passengers may be getting nervous. But once the engines restart and the runway clears, direction becomes obvious very quickly. Until then, stay cautious, stay informed, and remember, screens show price. Weight shows reality. Stay safe.